Welcome to Guide to Wealth. Peter Lynch turned the Magellan Fund into one of the greatest success stories in Wall Street history. But it wasn't just about picking the right stocks, it was about avoiding the wrong ones. Lynch warned us about the ones that sound promising but can quietly drain your portfolio. He didn't just earn legendary 29% annual returns by chasing trends. He did it by steering clear of common traps, stocks that looked exciting on the surface, but were disasters waiting to happen. In this video, we're diving into Lynch's 6 red flags, the types of stocks he warned investors to never touch, and why avoiding these could save your portfolio from massive losses. Let's break them down, one by one. Stock Type 1, Whisper Stocks. The too good to be true tip. What they are. These are rumor-driven stocks, shared through whispers at parties, golf courses, or family gatherings. They usually come with lines like, "A guy I know who works in the industry says this one's gonna explode." "It's a secret government contract, about to be announced." Why to avoid. You don't understand the company or its business model. There's no real way to verify the information. They're usually heavily speculative and often manipulated. Lynch's view. People buy into these with no knowledge whatsoever, and it usually ends badly. Stock Type 2, Turnaround Plays. Not all comebacks are created equal. What they are. Struggling companies that promise a turnaround. They might have a new CEO, a cost-cutting plan, or a rebranding initiative. Why to avoid, unless proven. Most turnarounds fail. Hope isn't a strategy. Without concrete evidence of recovery, these are just sinking ships. If the balance sheet is weak and execution unclear, stay away. Lynch's view. Beware of companies that are trying to fix things. You might be buying into a story, not a stock. But Lynch also made money on turnarounds only when the fundamentals backed the story, like cutting debt, turning profit, solid leadership. Stock Type 3, Hot IPOs. Get in early isn't always wise. What they are. New stocks hitting the market with a lot of media attention. Everyone's trying to get in early hoping it'll be the next Google. Why to avoid. They're often overhyped and overpriced. You're buying at the peak of excitement, not value. Many IPOs are from companies still figuring out how to be profitable. Lynch's view. You don't need to buy companies the day they go public. Let them prove themselves first. Wait and watch. The price often drops after the hype fades, then you can evaluate fairly. Stock Type 4, Overcomplicated companies. If you can't explain it in plain English, don't buy it. What they are. Companies with unclear business models, confusing financials, or jargon-filled explanations. They make money in ways that are hard to understand, even after reading the annual report. Why to avoid. You can't judge the risks or opportunities. You'll be flying blind, unable to react to changes or bad news. Complexity hides weakness more often than strength. Lynch's rule. Never invest in any idea you can't illustrate with a crayon. Lynch liked simple, understandable businesses, like Dunkin' Donuts or pantyhose sales, because you can monitor how they're doing just by being a consumer. Stock Type 5, Diversification stories. Companies that try to do too much. What they are. Firms that expand into unrelated businesses just for growth's sake. Example, a soft drink company suddenly buys a tech startup or a shoe company starts investing in hotels. Why to avoid. Management spreads itself thin. They often lose focus and fail at both the old and new business. The synergy they hope for usually doesn't exist. Lynch's term. Diversification, the opposite of smart diversification. Good diversification is strategic and aligned with the company's strengths. Diversification is just growth for growth's sake. Stock Type 6, High PE hype stocks. Price-to-earnings ratio sky high. Danger zone. What they are. Stocks with extremely high price-to-earnings, PE ratios, driven by buzz, momentum, or unrealistic growth expectations. Investors justify the high PE by saying, "It's the future," or "Everyone's buying it." Why to avoid. The price is built on future perfection. Any hiccup equals huge drop. High PE stocks are often already priced for success, no upside left. And the risk-reward is poor. You're overpaying for hope. Lynch's view. The P/E ratio is a good indicator of market expectations. If it's too high, it better be perfect. Lynch preferred stocks with undervalued PEs relative to growth. He looked for the PEG ratio, price earnings to growth. If PEG greater than 1.5 or 2, he got cautious. Final takeaway. These avoid list stocks tempt investors with buzz, dreams, or urgency. But Lynch reminds us, the best stocks are usually boring, well-run, understandable businesses you interact with every day. Peter Lynch knew the market rewards patience, logic, and common sense. Not rumors, not hype, and definitely not complexity. Avoid these 6 stock traps, and you'll already be ahead of the crowd. The trick is not to learn to trust your gut feelings, but rather to discipline yourself to ignore them. Want more deep dives into timeless investing strategies? If you enjoyed this summary, make sure to like, subscribe, and hit the bell icon for more insightful content. Happy investing!